Hello and welcome back to The Note. It's been a very good year to be invested in the stock market, particularly in the US, and it's been a lousy year to be a contrarian because almost everything has gone up. But there is at least one big exception to that, which is gold, which has had a bad year. And meanwhile, gold mining stocks have had a truly terrible year. Is there a buying opportunity there? With me now to discuss a year that has been very painful and whether there is any relief to that pain in sight is one of the world's best known gold investors. He's the CIO of US Global Investors, Frank Holmes. Frank, thank you very much for joining me today in London. Let's start by taking a look at the great gold chart. Obviously quite a bull market for over a decade and a startling reversal of that trend in the last couple of years. How do we go about measuring whether we're now ready to snap back again?
Well, there are two big drivers to gold, and that is I like to characterize them as the fear trade, which captures most of the publicity, and there's the love trade.
Right.
And the love trade is now approximately 60% of demand, and it's highly correlated to the GDP per capita of China and India. And we've seen the GDP per capita of India go flat.
Yeah.
And the same with China, so therefore that
well, not flat, but people have become much more concerned about the GDP of China.
Per capita.
Yeah.
And so that growth is a factor that's slowed down the momentum. And now you also have the rise of the US dollar and the current accounts getting stronger. So therefore, and what we really see is this 5-year government note now has a positive rate of return.
Okay, so at the level of the fear trade, people are less concerned about resurgent inflation, and the level of the love trade, we're not seeing the scale of the growth that we see. So you do see fundamental reasons why the gold price will have come back in the last year or two then?
I do.
Okay, now let's take a look. Your great suggestion over the years has very consistent advice for a very long time has been that people should have 10% of their portfolio in gold and rebalance regularly. This is what would have happened if we'd put 10% of our money into gold mining stocks as managed by yourselves and 90% into the S&P. You still have your noses just in front over 10 years, although not over 5. What is driving the gold mining stocks? Is that regular rebalancing trade still going to work?
I truly believe so. It's like car insurance. You don't want to go and have an accident to see if you can collect. You want to make sure if you do have an accident, you can collect. And government policies will go through this weave that I call it between fiscal monetary imbalances, and gold all of a sudden does this performance. I don't see the GDP per capita stalling much longer in China and India, so I think you'll see a resurgence take place there. And as for real interest rates, the real magic number is Treasury bills paying you 2% more than the CPI number, and I think the economic engine in America will stall dramatically if that takes place. So I think it's just still prudent to have a 10% weighting and to rebalance.
And certainly if you rebalance at this point, it involves taking some very nice profits in the S&P over the last year.
Absolutely.
Okay, now take me through the dynamics specifically. This is one of your very interesting timing models for looking at when, as I understand it, gold is overbought and oversold. Why should we think gold is truly oversold at this moment?
Well, what's interesting, John, is that every asset class has its own DNA of volatility. And we try to take a look at what percentage term creates a sigma move for gold. So
sigma is a one standard deviation.
One standard deviation 70% of the time. So 70% of the time, it is a non-event for gold to go plus or minus 15%. And 2 standard deviations would be a plus or minus 30%. So when gold hit $1,900, it was in fact a 2 standard deviation move, and we've gone a big correction. Mean reversion takes place. This is the most extended decline we've seen in gold. And so this sets a stage that earlier last year we had a substantial rally from it, and now we've had a rally, and now it's capitulating, it's falling over again. And odds favor that technically, when gold goes above its 50-day moving average, you'll get this massive mean reversion.
One quick final question is, it does seem to me that this showed that you should be selling gold 2 or 3 times during the extended bull market.
And you can do this with the S&P 500. Right. And you can do with any commodity. But I think what's interesting is that you're still seeing disinvestment of the bullion ETFs, but you're not seeing that in silver. In fact, the silver has come down in sympathy with gold. The silver buyers are actually increasing, and we're also seeing this in platinum.
Okay. Frank, thank you very much indeed. That was a rush through what has been a quite remarkable year in the precious metals market. I'm tended to be on the other side of the trade from this. I looked stupid advocating caution about gold for many years. At this moment, though, I have to say it does seem to me to make eminent sense to at least rebalance somewhat into gold. You rarely do that badly by leaning against the market.